Well, welcome back, my people. I hope you're crushing it out there as the markets propel back toward all-time highs, with Canada having a very uncertain economy, the U.S. dealing with geopolitics, a tariff war. All of this irrationality really proves why you can't bank on that, as the media shoves it down your throat for your clicks while the market keeps going up, and you don't buy because you were too scared when the market went down, and now it's too high for you to feel comfortable doing so, when the whole time you should have just been cost averaging, or at least doing what I do and get hyper giddy like a squirrel looking for a nut when those markets tank. Go all in, baby, because here we are at $428,000, almost $429,000. Obviously, over the year, I've been reconstituting, moving some stocks around. So with what I currently hold, I'm up 20% or $72,000 an annual salary for some, and that's mostly tax-free, sitting in my tax-advantaged accounts, that juicy passive income. But I really want to talk about the individual holdings in here, give you guys the weekly update. But before I do, I thank so many of you that went to KyleLivingston.com, booked a one-on-one, because there's a very common conversation that comes up, not as financial advice, but I do like to talk about planning and understanding where you're going in your future, and that can all be done with a compound calculator. And I recommend every single person utilize this beautiful tool that, Einstein claimed is one of the eighth wonder of the world. But we're going to show you this real quick just to give you an idea of like how I'm constantly planning for my future. And then I want to talk about Google, Take-Two, Meta, these individual stocks. So if you're on a path to financial independence, if you damn well one day want to retire, I'll blow you a kiss if you hit that subscribe button. It's kind of weird, I know, but let's get into this first and foremost here, folks. On this Canada long weekend, we got Canada Day coming up here, but firstly, when I'm talking to people on a one-on-one and individual basis here, the real conversation comes down to, when do you want to retire? Where are you at? I always love the idea of Dave Ramsey, get rid of all your debt, because this compound calculator doesn't work for debt. That's pulling you back. You need to have that shovel of cash coming in, how much you're going to save. So let's say you're 20 years old and you want to retire by the time you're 45. You don't want to work forever, right? You want to kind of fast track that. So let's presume you're able to put $1,000 away a month, or $12,000 a year. Let's say you're going to be doing that for 25 years. What rate of return are we going to have to get, and what number are we going to need to be comfortable in retirement? And this is presuming a 4% or even a 5% withdrawal rate if we can get that off a dividend. So let's presume if you're getting $1 million, if you can get 4% off that, 4 to 5%, that's 40 to 50K in cash flow. That's a decent sum of capital. I mean, depending on where you live, if you can live off 40 or 50K, that's like guaranteed, like roof over your head, food on the table kind of money, right? Maybe you want a bit of bleed room, so you might need a bit more, but let's presume over 25 years, if we can get maybe S&P 500 like returns, it is the path of least resistance. Over a 20-year period, this has never lost money, and historically, since inception, it's returned about 10.36%. So let's presume that continues at about a 10.36% clip. Let me back that zero out of there. How much money would that leave us with over a 25-year period at $1,000 a month? That's 1.37 million, around 1.3 mil. So if you're going to be able to get 4 or 5% off that, you could really easily cash flow somewhere comfortably between probably 50 to 70K. That's a really decent income, and most of that could be pretty tax efficient, because as we know, especially on qualified dividends on the first 50K, if it's out of a tax advantage account, you don't pay any tax really anyways. So you could be making, that 50 to 70K completely tax free. That is quite beautiful. Anywhere getting that 4 to 5%, never touching the initial equity. So use this tool, guys. I'll leave the link in the description below, and figure out what your goal is, how much money you can put away, and what it's going to take to get you to your retirement number. If that's 2 million, figure out what you got to make on that 2 million, right? Because everyone keeps asking me, like, why do I buy VDY over XEI? Like, what is my thought behind these stocks that I hold, or these ETFs in my portfolio? Because there's people are like, there's way better ETFs in Canada than VDY, but I'm like, is there? I'm a market cap weighted guy. Market cap weighted ETFs, regardless of how you feel, will weight stocks purely off their market cap performance. So for instance, I was way too dumb. Does it show me the holdings in here? Where are the holdings? We know that NVIDIA really quickly became one of the largest companies right here in the United States, like overnight. And I thought it was a bubble. Many people did. And then it proved its value. I would have been too dumb to own that. But I think in 2023 or 2024, a few percentage points of gains, or like half the S&P 500's gains, just came from NVIDIA. And I would have been too dumb to capture that, but I captured it because I recognized that I don't know everything. Analysts don't know shit. I don't know what's going on tomorrow. So why not just market cap weight the ETFs? So only own a percentage of it based on how big its market cap is. And if it starts to underperform, it'll de-weight its way out of here. And I'm too dumb to own Tesla right now, but let's say Tesla stays at this value. At least I'll capture the upside. And if there is downside, it'll get weighted out without me having to manage it. And that's why I like VDY till I motherfucking die, because VDY has since inception offered a 10% rate of return return, right? And historically, it's done very, very well over, say, XEI, which has roughly the same track record of time, but XEI's rate of return has only been 7.48%. And the only other good Canadian stock to own, and the only reason I don't really want to own it is because it's not market cap weighted, is XDIV. This is probably one of the better ones because not only is the yield much higher, but since inception, it's paid out about 10% as well, annualized. And yeah, the yield's about 4.1%. So people will chase, say, XEI because the yield is closer to 5.45 and they think they're getting ahead. But realistically, XDIV and VDY have offered much more exceptional rates of return. So that's why I'd rather stick to VDY, though XDIV has done very well. It's just not market cap weighted. And I'll always go back to a market cap weighted ETF. It's where I live and die because, you know, recently we did sell SCHD. We did get a good gain off of it, a reasonable gain, but nothing where we should have if we just put it in the S&P 500, because I did sell Tesla back in 2022 era to buy this, and I gave it a good few years and it just didn't pan out. I mean, we saw hardly, you know, material returns during the same period. So, you know, I gave it its time. I recognize it's not a market cap weighted ETF. Over time, if it's not market cap weighted, you're going to run into situations where it's likely to underperform. And, you know, if you're looking 10, 20 years out, I just want the path of least resistance with the best rate of return possible historically. So that's my decision making behind those ETFs. But moving on to those individual stocks, sorry to interrupt, just really quick, I want to shout out Gary Gill. I just did a 2-hour podcast with this incredible gentleman on finance and these very same discussions. I'll leave the link in the description below if you want a more in-depth conversation about a variety of finance topics. But thanks again, Gary. We've actually been doing very well. I don't think I've done anything wrong with the individual stocks I bought lately, but we're also in a bull market, so don't get cocky with yourselves, because I know a lot of people are buying smaller cap companies, seeing massive, massive gains, but you do have to recognize that we're in a bull market and there's a lot of, you know, momentum going on in these stocks. And if we go into a bear market, same with crypto and a lot of these speculations, if you're the one buying the tops now and you're the one chasing like 500,000% gains that we've seen on some of these stocks, we very likely could see something very bad in the opposite direction if we ever go back into a bear market. Because a lot of people are, and I'm still calling this an AI bubble. I mean, I think we're sitting in a relative AI bubble. A lot of stocks trading at values that well exceed beyond the dot-com era. And if those stocks correct in any material way, and God knows if they do, it could be very detrimental, which is why I'm highly selective about the individual stocks that I do own when it comes to things like Google. I think is the most superior AI play. And a lot of people are still speculating on why it hasn't rallied all that much. We finally went back in the green, getting above my cost basis of, I think, around 172, 173. It is the largest position in my portfolio, or in the wife and I's combined accounts. And I think the biggest concerns that we have to get through is still the actual resolution of the monopoly court case in the US, and if they're going to have to divest Chrome or Android, or what's going to happen there. And I don't think it's going to be as detrimental as people think. That's coming up in August, but we also have earnings coming up. But a lot of people are recognizing that between self-driving, the fact that I think NVIDIA's, or not NVIDIA, but what company? I think ChatGPT, OpenAI have been leaning into Google's infrastructure to actually power ChatGPT. Like, a lot of people are recognizing that Google's very integrated into this AI future, and Gemini is the leader right now in AI in many, many different areas. So the only thing Google has going against it is the constant combative nature of search and self-driving, I think, are the two major things. And I just want to remind you, like, I don't beat on Tesla just because I beat on it because of the valuation and the fact that people think it's way farther ahead than it actually is. And I think you see that in a lot of these videos now coming out of them testing Robotaxi, because Robotaxi seems to be at the exact same level, a little further behind than Google is, you know, just based off what I'm seeing. Watch this video of just something really peculiar that What's Inside family noticed.
We have Robotaxi right here, and then we've got this one that has LiDAR on it. Look at that. LiDAR on the top, manufacturer plates, and the Robotaxi right next to each other, doing some testing because we brought it to the Tesla supercharger. That's the closest we could get to it. Kim, did you see that car just go by?
Yeah.
It had LiDAR on it. It was a manufacturer test. It was a Tesla one with LiDAR. Well, yesterday when we were racing, we were driving into the sun. And if you remember, there's a point where I'm like, sorry about the lighting, it's terrible. For the Waymo, well, the sun's right in our face. For the Robotaxi, you can see the sun right in her face. It is shining all over directly in her face. And then bam, phantom braking. It thought it saw something. So that's kind of the question. Does it need LiDAR in order for it to get level 3 autonomy or even...
So this is the real interesting conversation that, everyone was crapping on Google about, saying, do you really need all these sensors? And again, I always revert back to the idea of a plane crash, right? Like anytime a plane crashes, they add extra redundancies, like extra things to ensure that never happens again. And I think there was another good video here because a lot of people if you go on like stock twits, they're just shitting on Google relentlessly when it comes to the issues with Gemini over, Tesla. And they show this video here.
Actually get hit here.
The two say they saw a man in the passenger seat of the wrong way Waymo.
Oh,
He couldn't do anything, and that was what was so scary because he kind of he threw his hands up. You can't really see it in the video.
Both Hall and Wiest are familiar with Waymo, having taken rides in one before.
I still felt a little safe going on Waymos. Now we're like, we're not
Never
gonna get
again.
a Waymo again.
Well, no one died, and I'm like, this time.
Just driving in today, I turned onto campus and there was a car driven by a human coming straight towards me, which just illustrates that humans make stupid mistakes all the time on roads. So do Waymo.
Andrew Maynard, who uses Waymo often, has a different opinion.
They are always on point. They're not like humans that are looking at their phones, listening to music, eating, looking down at the floor. They are hyper aware of their surroundings.
Maynard is a professor of advanced technology transitions at ASU. He says data shows that Waymos are safer than human drivers.
Waymo at the moment offering these...
And even these stats are a little skewed, but at least Waymo has never unalived somebody, which is great to know. But yeah, it was funny that they're freaking out. It got in the wrong lane. It were going really slow, and then, probably somebody intervened like remotely and converted it back, or maybe it figured it out on its own. But the reality is Tesla's facing the very same problems. The Teslas in a lot of these examples have done some really peculiar things, like the phantom braking, turning into the wrong lanes. A UPS truck was backing up, and the Tesla, the guy sitting in the passenger seat, had to take over, and there was a good chance that UPS would have backed right into that Tesla. And keep in mind, Tesla's only just doing this with like a handful of vehicles right now, testing this out. This isn't even at scale. Waymo is already scaling. They're superiorly ahead of Tesla, which is why I'd rather own Google, because it trades for a much cheaper valuation. And Tesla's full autonomy is clearly a bit of a fallacy. It's a bit of a hype YouTube fake thing. Like, I've seen great drives with it for sure, but if it can't operate with light in it, if it can't operate under certain weather conditions, like what happens if all these Teslas are operating and then flash storm hits for no reason? Like, are all these people going to be sitting behind a remote desk somewhere saying, go home, go home, go home before this major storm hits? Like, those are real realities that they can't run into at scale. And clearly your car is not going to be a robotaxi anytime soon. So the valuations, to me, again, I'm not trying to beat on Tesla. You just can't help but recognize that Google is the actual leader in this space, has the redundancies, the protections, and the things that are operating today. And it seems, according to that video, Tesla's even trying out LiDAR still. For all of you that were shitting on LiDAR, I think it's hilarious that, people are starting to wake up to that reality. It was nice to see as well Take-Two Interactive on the other spectrum of our stocks hit another all-time high this week. I think we hit just around 248 or something sometime in the intraday, which was kind of wild. Or I think it was well over 245, but here we sit. The stock pulled back a little bit. I don't know if I'm going to hold this all the way to GTA 6. I think the hype train that it's going to bring is going to be miraculous, but I'm also recognizing that we're in a bull market and this stock isn't exactly cheap, and I'm hoping that we can run up to a 50 to 60 bill valuation. If we get there preemptively long before GTA 6 comes out, I would have hit my targets. I don't know if I'd want to take the market risk, so I'd probably take the majority of my capital out of this, maybe keep a little bit more for speculating, but still, you got to recognize that we bought this at an average price of around 211, and we've done pretty well. I mean, outpacing the S&P that went down and is only just flat now on the year, finally going green, whereas this is up about 15%. If I can lock in a 20-25% gain pretty early on, that'd be great. I am speculating that I should be able to get an easy 50% to a double out of this, because I believe it's going to run to a 60 to 80 billion valuation. If they keep diluting us in between, that could hurt some of the run up, but nonetheless, I think Take-Two's done very well for us this year, and it's offered way more stability. The only regret that I have is that I didn't go harder on Meta. I feel like we could still own a bit more Meta in our portfolios, because I bought this thing at around 240-ish right when it was coming out of this major dip, and we're already up 30-40%, seeing a much more substantial gain much quicker. Meta's been a gem in the account. This thing's running back up to a 30 PE where it's deserved. Hopefully Google can run up to a 25, 30 times multiple, at which I'll pull some profit out of Google. I do want to hold Google long term, but if it can get back to a more respectable valuation, and I can lock in some really quick gains like I try and do with some of these positions, then yeah, I'm obviously going to take some of those gains out and stick to the original plan of taking those gains and cost averaging them into my global market ETF, XEQT, VDY, and VOO, just to continue building that preservation, that fast track path to financial independence. Because the reason I buy individual stocks, most people shouldn't. The reason I do is because I've done it successfully for over a decade. And I recognize that even if, I don't need my whole portfolio being individual stocks, but if Google, Take-Two, Meta, if these can even pull forward an extra 1 or 2% of gains out of my account, let's just say we go from a 10% average to a 12% on $1,000 a month over that 25 years, that really quickly equates to an extra several $100,000 and can fast track me to an extra huge chunk of change, considering I'm putting away a substantially more amount of money. I don't know what my average contribution is, but I've always tried to do from the beginning at least $2,000 a month, at least minimum. But yeah, my goal is to really scale my portfolio by the time I'm 35, but be in a very healthy place by the time I'm 40, where I don't really have to rely on much of anything. By the time I'm 35, my goal is to have that enough money to substitute housing income and just to put some food on the table, and ensure that if I don't like my job or you're not enjoying life, you can switch things up without concern. But by the time I'm 40, I really want to have a substantial level of capital, and I'm hoping these individual stock picks will only benefit that greater. But if they do detriment me, I'm already in a good position to take the losses, and you might not be. So do keep that in mind. This is not financial advice, just of course opinions of my own, but I will pass that off to you as always. I'd love to know what you think in that comment section.